Hello, Jim here. Selling options is a great way to make some extra income on a monthly basis, as well as to pick up some really good stocks and ETFs. Today, I want to talk about my favorite methodology for doing just that. It's the vertical put credit spread. I add a unique twist to it. I'll share with you the details about how I use it differently to really make it work for me. At the end of the video, I'll share an actual trade and I'll share a checklist that I'm setting up just for doing the vertical put credit spread. So stay tuned. I think it's going to be well worth your while. Okay, let's go ahead and jump right in. I do like to give a quick market update. We've had pretty crazy week or two related to earnings. Companies, if they have good earnings, they shoot right through the roof. If they have bad earnings, they get clobbered. I do believe, at least from my experience over the last, I've been trading going back 30 years. I don't remember this kind of impact related positive or negative to earnings. I do believe it's a little bit more elevated than it used to be. But typically what happens if a company misses earnings, it drops majorly, but then it kind of moves back to the mean. And the same thing is with if they beat earnings, it'll slowly come down. So you have to be patient, especially if you miss earnings and the stock drops 10, 15, 20%, which now it seems like it's a common occurrence. Be patient, that stock will recover. I've seen it happen with stocks that barely miss earnings or beat earnings, but then give poor guidance. I also think it will probably continue for a while. If you're an options trader, it actually makes it a little bit better. You can potentially pick up better premium. Now, the Fed did come out. They held rates steady. They also kind of hinted to probably keeping rates steady or the same in September. I prefer them to do a quarter point cut, but they're going to do what they're going to do. I just don't like seeing huge changes too quickly. If they do nothing and they keep rates the same going all the way to when Trump replaces Powell, then Trump's going to have whoever replaces him make big changes really quickly. I'd rather see quarter point changes and see kind of a small transition versus, 2 or 3 half points in 2 or 3 meetings. And, people can't plan for that as well. I prefer something a little bit more reasonable that we can plan for. But, again, that's my 2 cents, and it's probably only worth 2 cents. Now, the one thing I tell people in all my videos and whenever I meet with members or even leave comments to subscribers, what's key is picking the right companies, picking a great company or a good company that has good fundamentals, good return on equity, good return on investment, or even return on assets, little debt to no debt, growing steadily in a healthy manner. Also, if they pay a dividend, that they have a low payout ratio for that dividend and that they're increasing it over time. I do believe fundamentals do make a difference. I will also use technicals. I like to use Bollinger Bands. I'll look at RSI to measure, once you've identified a company you really want to own, then it's trying to find a good, reasonable entry point. And that's where, in my mind, the Bollinger Bands really make a big difference, identifying the lower part of that band and then also looking at RSI. Is RSI fairly low, like around 40 or lower? Is it a good entry point at this time for the stock? And not necessarily at its current stock price, but if you're going to be selling a put, maybe it's that short put strike that you're looking at. Is it towards the lower band for the Bollinger Band? So that's what I like to do. I also will go way out for a chart and I'll look to see if I pick it up at a specific price. How does it look on that long-term chart? And that typically will give me a feel. If I get a sign, am I picking it up at a really good price where I want to own it? And since I'm an investor, then a trader, that's really key for me. I really want to own a lot of these companies and see them, double, triple over the next 5 or 10 years. It's what I've been doing for many years. I also like to pick up good dividend payers, companies that are growing dividends and potentially growing dividends quickly. It can have a major impact. 10 years of dividend growth can be huge. It can be a significant amount of money. Next, once I identify the entry point in the stock, then I also like to look at an expiration. And I picked the expiration more about getting into that price that I want to get to, that entry point. So I may go out farther. I might go out 60 days and pick a lower entry point. Or if it's a very reasonable stock and it's been beaten down, then I might pick an entry point that's closer, maybe 30 days, maybe even less than 30 days. But again, a lot of it depends on the strike price. I do like to look at delta. So a lot of times for a vertical put credit spread, I will look at trying to pick it up around a 15 delta. So if you go out 45 to 60 days and you do a 15 delta, it's like a 10 or 15% discount from the current stock price. Now, if you're not familiar with what a vertical put credit spread is, if you sell a cash secured put, and this is what I tell my members, someone pays you some money to sell you that stock, and it can be a fair amount of income, but for a protection, meaning the stock price is very high or the market in general is very high, you want to pick what's called a long put. It's a put where you're protecting yourself on the downside. So if you sell short like a $50 strike for a stock that you want to own, meaning you want to own it at $50, if you go out $10 and you buy what's called a long put, if it goes below that $40, you're protected. You can put that stock to someone else at that $40. Now, depending on where you stand, what level for trading options you are with the broker, they'll give you credit for that. They'll say, well, you sold a 50, you bought a 40, you only need that $10 spread minus whatever premium as required capital. So it's another benefit. I also like to look at the surrounding strikes to see if maybe there's a thinner spread that's a little bit cheaper. And I've probably 40% of the time I found that's the case. And that allows me to define my risk. I can determine what that spread width is, and then I can determine how many contracts I want to do. I typically do 1 to 2 contracts. If it's an inexpensive stock like a Mara or a SoFi, meaning around 20 or less than $20, I might do more contracts. I might do 4, but I rarely do more than 2. And for expensive stocks like the Amazons, the Googles, even AMD this day and age, I usually only do 1 or 2. And I really like buying that long put, especially if it's cheap. If it's $5 or $10, one thing I've been telling members recently, and I haven't had the opportunity to do it, is if it's really cheap, say $5, $8, $10, well, why not buy 2 or 3 of them? So if you're selling 2 puts short, why not buy 3 long puts? And then if it goes against you, you'll be even more protected. And so that's something I'm considering. I've played with it. I've played with it in the trading page just to see how it would work out. I haven't made a trade like that yet, but I plan to probably in the coming weeks. And then I really like to adjust the spread for max return, meaning, like I said before, adjusting how wide that spread is. Now, if it's a really, really good trade and it's got a really high return on investment, and I just measure the return on investment by the premium divided by the required capital adjusted for the year. If it's really high, say over 200 or over 300, I might do more contracts. Maybe I'll do 3 or maybe 4. Now, I do have some members that will take a lot more risk. They may go to 10 contracts. I do request them to put that into what I call my risky text channel within Discord, because I don't want other people taking that kind of risk where they do 10 contracts, or maybe they trade on some securities that are a little bit more risky. Maybe they're leveraged ETFs, or maybe they're Bitcoin related ETFs. And we put that into the riskier type of trades within the Discord. So, but if I find, like I said before, a really good trade, I'm beginning to take the steps of taking a little bit more risk with it. And the best traders out there, that's what they do. They might bet a bit more on a really good trade, understanding, well, wow, this is a really good trade. This doesn't come along very often. So those are the main things I wanted to talk about. Now, when I trade, I probably half my trades are vertical put credit spreads in this time frame, like of between 30 and 60 days, usually around a 15 delta. It's never exactly a 15 delta. It might be a little bit higher. If there's a 14 delta and a 16 delta, I would pick the 16 delta, but at least half my trades are these kind of trades. And they've been very, very successful, probably well over 90%, maybe well over 95% when they have been assigned to me. And again, if I've picked a really good company and a good entry point, then I want to own them at that entry point. So even if they are assigned to me, it's not really a loss. It's, when you pick a company you really want to own, you have a lot of faith in that company, you see it doubling maybe in 5 years, like Google or AMD, then there's very little risk with doing it. I will buy some stocks, like I bought some AMD. Well, not AMD. I actually bought some NVIDIA recently because I had 150 shares. And I may do the same thing with Home Depot. I have, I think, 47 shares of Home Depot. So other than those instances, the way I pick up the stocks or ETFs is by selling cash secured puts or vertical put credit spread. But like I said before, for every one cash secured put I probably do 2 or 3. And I always tell people to start with that cash secured put and then add that extra arm, see what you pay for it. And then when I share my trades with my members, I also will make comments. Well, maybe you want to do this as a cash secured put because I paid a lot for these long puts, and you may not want to do that. You might want to pick up an extra $100 or $200. So that's what I wanted to share, and we'll go into even more detail when we go through the checklist. So, and when I actually share with you one of my most recent trades. So stay tuned. Let's jump into the next section. Okay, now I've opened up my new vertical put credit spread checklist. This is what I create for my membership. I have several checklists now. I have a covered call checklist, a cash secured put checklist, what I call my filtered covered call checklist. So before you actually do the covered call, it helps you identify if you should do it. And this is my latest. This is still work in progress. I'm getting feedback from my membership, and I'll probably make changes to it. But the idea is to have something at your fingertips that can potentially help you with making the trade. So here, everything you need to place a vertical put credit spread trade with confidence. Before placing the vertical put credit spread, begin with the cash secured put checklist. So I might end up adding that part of the cash secured checklist here. But the main reason I'm saying that is you can come over here, you can look at the fundamentals, how to choose the right company. Then you could analyze the technicals. Then you can define your risk and choose your strike. And then step 4, you build your options order, which would take us back here. So you would use the beginning cash secured put checklist to come up with what strike you would want to sell that short, what strike or what price you want to own that stock at. Then you come over here and then you confirm the market and timing conditions. Be sure that earnings isn't coming up or a major news event potentially isn't going to be happening. You can do that by using, I like to use Seeking Alpha. There's a tab for earnings, so I'll go there. I'll also go to the company's website and look to see if they have any big announcements coming up. RSI, this comes partially from the cash secured put, but I'll also look before making the trade, where does it stand? I'll also look at the Bollinger Band. Then I'll build the spread. I'll sell the put near a 15 delta. I'll then buy a put 10 strikes lower for protection. That's where I typically start. So I would add another arm. I'll start with a cash secured put, then I'll add another arm, and I'll go $10 strikes out. And then I typically do 1 to 2 contracts. So you can see there's check boxes here, up to 4 contracts if stock is low priced or fits capital plan. So if it's a very not overpriced stock or a very affordable stock and I really want to own it, or it's an ETF and I'm just accumulating that particular ETF like SCHD, then I might do more contracts and then confirm max loss and margin risk is acceptable. So do I have enough cash to make this trade? Is it too risky? A lot of cases, my trades are not overly risky. Then step 3, test spread widths for best value. So again, I start with a 10-point wide spread. Then I check the 9, 8, 7. So if you sell a 50 and then you buy a 40, well, then I might try the 41, I might try the 42, I might try the 43. And in some instances, again, you will find that a thinner spread might be the more profitable trade. So, and I do try to target around 100 per contract. So if I do 2 contracts in the trade, I'm trying to make 200 on that trade. A lot of times it'll be like 220, 230, 240, or if I think the stock's a little bit pricey, well, it might be a little bit less profitable. It might be more like 170, 180. But I try to get as close to that 200 per contract as I can. Here I'm just showing in the instance where you might find a 40-32 might be more profitable than a 40-30. And this is just showing, and you can do that really easy in the trader page. Just change the strikes and just look at the premium, just see if the premium looks good. So this is just an example of how it would work. Add protection if the trade is cheap. So I tell people, members, subscribers, if you set up that trade, especially for an inexpensive stock, so if you're looking at Mara, I believe the first trade I ever did with Mara, the long puts were like $2 or $3, and I only bought one. But going forward, if they're that cheap again, I'm probably going to do more than one. I might do 2 or 3. It just gives you extra downside protection for minimal cost. And then step 5, confirm and submit the order. Use the sell to open and select the put. Choose expiration. Again, I like to do 45 to 60 days. But on some names that have great premium, great implied volatility, like AMD or Amazon or Tesla, you don't have to go that far out. Maybe a 30-day will work just as well. Or maybe even a weekly. There was a time when I did Apple every 2 weeks, and it worked out really well. And then use a limit order for control. And a lot of times when I put the trade in, I'll do the ask. I'll do right at the ask these days, because I've been surprised how many have been assigned to me right at the ask. So, or a little bit higher than the ask, because you have the bid, mid, and ask. And the ask is typically the most, anyone has asked for, selling that particular contract. Use the limit order. Again, I just mentioned that. Double check total premium, risk per contract. So double check everything. Every broker gives you an opportunity to review it. Just take the necessary time. You don't need to do too many of these trades. I do 1 or 2 a day, and it works out really well. So it's worth taking the time, because if you do make a mistake, you can fix it really easy. You just put the trade back in reverse. So say you sell a 50 and you buy a 40. Just put in the opposite, buy a 50, or what is it? Sell a 50 and buy a 40, or you get the point. You just, you buy and sell the opposite situation. And then step 6, monitor and manage the trade. Know when to take profits or exit. I like to take profit probably closer to 90%. I'm really cheap. I prefer not to spend a lot to close it, but I'm more willing now. I'm closing a lot more. I believe this month I've closed more than I've opened, and I'm pretty sure I did. Well, I know I did that in June. And then I began managing at 21 DTE. So I will potentially do it a little bit earlier than that, but by default, I'm typically checking to see if I can roll any of the positions, or if they're really profitable, can I just close them? I probably have closed 2 or 3 this week. So consider rolling if the short strike is being tested and the setup still qualifies. And then avoid holding through expiration unless deep out of the money. Some of the best traders I've talked to who do better than I do, they close more like at 60 or 70%. So there's times when I wish I had closed, and then, I missed the opportunity to close. And then the market, especially going into April this past year, the market takes a huge dive and you've missed that opportunity. But again, if you're picking the right companies, you're picking the right entry point. For me, the bigger issue in is April or in April was I wanted to own more of those shares. I had a lot get assigned, and you know, I would sell some of the shares and keep others. So optional track to trade the log. So I have what I call my planning worksheet. Most of my members use it. I'm looking at an automated or better tool to do that. I have one member that's looking to build something. I might build something depending on, you know, what he creates and how long it takes. But it's really important. Set up some kind of a journal where you're tracking your progress. Set goals. I like to tell all my members when I consult with them, set some kind of a goal, even if it's like I want to make my car payment every month, and that's my goal. And you do that for the first month, then you up it. Maybe it's to pay your car payment and then pay your energy bill or something along those lines. So I've set goals from the beginning. I started with 1,000, went to 2, 3, 4, 5, 6, 7. Then I think I went to 8, but then I backed off because I had some issues for a couple of months, especially in I think it was early in 24. And so I backed off, and now I'm back to 8,000. I'm trying to make 8,000 a month, and I'm really close to that across all my accounts, around the 1%. For all my accounts. And that may be my next goal. I may try to see if I can get 1% across all my accounts. Now, some of you might say, well, that should be really easy. But remember, I have especially in my brokerages, but now even in my retirement accounts, I'm mostly invested. I don't have as much cash. I maybe have 150,000 in cash. I own a couple hundred shares of AMD, a couple hundred shares of Google, a couple hundred shares of Zoom, and a lot of the companies I like to own, even some of the other chip makers like Micron. So I don't have as much cash to trade in. And then it's also, how much do you really need? I feel like some people get a little bit too greedy. You know, the old proverb, what is it? Cows are eaten and hogs are slaughtered. If you become trying to make too much, trying to bring in too much, or double your account way too quickly, usually it'll catch up with you. You'll end up having a bad month or two, and your account will suffer because of it. So set goals, also be persistent, consistent. Take your time, try not to let biases get involved. Like right now, recency bias could be a big issue with the market being so high. So next, I do want to jump in. I want to share with you my latest trade and how this process worked out really well for it. So stay tuned. Let's jump into that. Okay, here's a trade I actually made yesterday. I did not realize it got filled until this morning, but it was ODFL, which is the Old Dominion freight line. I've traded in them before, don't own any. So the previous vertical put credit spreads pretty much expired, or I closed them for a really good profit. But I sold 2 vertical put credit spreads on Old Dominion with strikes of 130 and 120. I believe at the time it was right around 150, expiring on 9/19/25. So I went out around 50 days, 51 days. This is what I share with my membership. This is in my Patreon. I post my trades here. Right after I make them, I then post them within my Discord. I'll make any comments. This is Old Dominion Freight Line. They barely missed earnings and were hit hard yesterday. I had not realized that they were filled until this morning. They have good profitability, cash flow. They are fine with debt and are a bit oversold. They have little growth, but pay a small dividend. I do think they will revise revenue upwards as onshoring continues over the coming years. So as we have more manufacturing, I think it's going to benefit Old Dominion. They are one of those companies I wish I had owned some shares back in the early 80s. If you go back to that time, they have amazing growth. And I think that could potentially get into some really good growth in the coming years. Here I share each of my trades. This is a cut and paste literally from whichever brokerage I'm trading in. This is Fidelity. But you can see with Old Dominion, here they had earnings. They missed by 2 cents for normalized actual and 1 cent for GAAP. And then revenues were just down 8 million compared to what they estimated. They next have earnings in October. This is Seeking Alpha. Details for this will also be in my description. I'm an affiliate. If you sign up through me, you do get a bit of a discount. I do get a kickback. But you can see here, they really got hammered. If you look at 5 days, so this is about when earnings came out, and they've been kind of going sideways, trending up slightly. And I've seen that happen. If you go out a month, you'll see that they'll probably trend up slowly. They'll get up into the 150s, 159. They have good profitability, just overall a good company. Now charting, this is what I was talking about before. You look at S&P 500 for 1 year, they haven't done as well. For 3 years, you go out 5 years, and suddenly things are changing. 63% versus the S&P 96. You go out 10 years, and it's pretty substantial. And you go max, and you can see the crazy how much better it's done than the S&P 500. Literally almost 30,000. If you go back to, like, I started trading in the 80s, so this doesn't even go all the way back. This goes to 95. So at one time they had amazing growth, and they've been kind of puttering around, but I do think they're going to go back up. If we look at bar charts, now if you were looking at the interactive, the Bollinger Band, 130 is all the way down here. So I'm literally below the lower band. And then RSI has dropped big time into the 30s and 40s. And they're up today. So they're up $1.26. They were up a lot more earlier. So overall, just a good company. And the fact that they're 147 and I have a 130 and a 120. So you're talking here and then down here is, so I would have to majorly drop, but I think it's going to go the other way. What I found with a lot of companies like this is they rebound within the next couple of weeks, and this becomes very profitable. So instead of, even though I did it 45 to 60 days out, I'm typically able to close it 2-3 weeks early. Some cases, after 3 or 4 weeks, I'm able to close it with a really good profit, and it becomes a very profitable trade. So you can kind of get a feel for it. And again, most of my trades are like this. So this is what I wanted to share with you guys. Like I said before, this is by far my most successful trade. The other thing I forgot to mention is if the market does do a dive and you purchase these long puts, you can really use them. You could sell them to lower your cost basis, and you just have that protection. I ended up using them in April. I used them quite a bit. I sold most of the long puts and kept the shares. And in a lot of cases, those shares have doubled, like my AMD, my Micron, my STX, I could name several others, Google. So having them and using them the right way can really make a big difference. So let me know what you guys think. What's your favorite type of strategy to trade? Do you do vertical put credit spreads? Are you more cash secured puts? I really like to hear. I typically will respond to all my comments within 24 to 48 hours. So just wanted to take one more second to thank you for taking the time to watch the video, and I hope you have a wonderful evening.